Okay, let's unpack this. We are looking at what seems less like a gradual evolution and more like a total strategic immolation and rebirth.
That's a great way to put it. We're talking about a major player in digital infrastructure that has, well, consciously torched its entire historical identity.
All to fund a hyper-aggressive pivot.
Exactly. For the longest time, this company, Bitfarms, was known primarily as a global, diversified Bitcoin miner. They had huge operations in South America.
And now
they have effectively declared that future dead. This is no longer a mining story. It's a massive, capital-intensive race to become an AI infrastructure utility.
So the core action here is just so definitive. They've executed this vast financing program to fund an infrastructure build-out.
Right, one focused entirely on high-performance computing, or HPC, and AI workloads, and it's all happening in the United States and Canada.
While at the same time, they're liquidating every single asset they own in Latin America.
Our mission in this deep dive is to really synthesize this monumental transformation for you. We need to understand the financial foundation they built in Q3 2025, the staggering scale of this new $500 million debt financing.
And exactly how they managed to clean up their geopolitical past to fund this entirely new future.
So let's start with that cleanup. The exit from Latin America feels like a very deliberate move.
Like they're scrubbing their balance sheet of any perceived risk before diving into the AI era?
That's exactly right. The Latin American exit is the symbolic end of their past. The first big move was the formal abandonment of their Rio Cuarto operation in Argentina.
That was a pretty substantial site, right? 58 megawatts.
Huge. And the operations there were halted after their energy supplier just cut power back in May of 2025.
So it sounds like a forced exit, in a way. Energy stoppages plus, all the regional economic uncertainty. They decided to formally abandon the site by the end of Q3 2025.
It was certainly accelerated by that power cut. But management, even in that tough situation, found a way to create a clean financial exit.
How so?
They walked away from the leased property, and crucially, they negotiated away a $2.8 million asset retirement obligation.
The cleanup costs, basically.
Exactly. Mandatory cleanup costs they would have had to pay. It's a small win, but a smart one in the middle of a major strategic retreat.
Then there's the final piece of the puzzle, Paraguay. That was home to the 70-megawatt Paso Pe site.
Right, and that facility was officially classified as held for sale as of September 30, 2025. That really solidified the shift.
And now we know they've sold it.
We do. In January 2026, they reached a deal to sell it to the Sympatheia Power Fund for a total valuation of up to $30 million.
Okay, but hold on. Selling a 70-megawatt site for potentially only $9 million up front is accelerated free cash flow, just corporate speak for, liquidating assets quickly to panic fund a new strategy.
It's definitely aggressive, but I think that phrase is the key. They are taking an estimated 2 to 3 years of anticipated free cash flow from that site and cashing the check today.
So they get the cash now.
They get it now. They secured $1 million deposit, with $8 million more at closing. The other $21 million is tied to future performance milestones. They're prioritizing immediate capital for the North American buildout.
Betting they can generate much faster, stronger returns in AI.
In AI than in a volatile Latin American mining market. And it looks like they got out just in the nick of time.
Right. There was that regulatory pressure building up.
A crucial point. In December 2025, the Paraguayan House of Representatives started demanding official data on all registered crypto miners and their electricity connections.
A tightening regulatory environment that they are now successfully sidestepping.
Exactly. So this whole pivot, it didn't just come out of nowhere. It was built on a surprisingly strong financial war chest. Let's look back at the operating foundation they built in Q3 2025.
From their continuing North American operations.
Right, and the financials are what gave them the runway for this whole move. Total revenues from continuing ops hit a massive $69.2 million in Q3 2025.
Which is what, a 156% increase year over year?
A huge increase. But what's fascinating is the margin picture. Gross mining profit was $21.1 million, but the gross mining margin actually dropped a bit to 35% from 44%.
That drop in margin during a revenue explosion, that suggests they were already investing heavily, right? Higher operating costs, maybe tied to that vertical integration in the U.S.
You've got it. But the cash metrics just soared. Adjusted EBITDA, that key measure of operational cash profitability, hit $19.6 million.
Which was an astonishing 790% increase from Q3 2024.
Just incredible. The net loss was large at $46.3 million, but that was mostly non-cash stuff like depreciation. The cash engine itself was running hot.
Let's talk production. Network difficulty jumped by almost 50%, but they still earned 520 Bitcoin.
Up 26% year over year. And that was all about efficiency. The fleet upgrade program was a huge success. They brought in 85,442 new miners,
improving their fleet efficiency by 14%.
And they got their average down to 18 watts per terahash, or WTH. That's down from 21 a year prior. For you, the listener, WTH is just how much power you need to generate 1 unit of hashing power. Improving that means you are squeezing every last drop of performance out of your energy.
Okay, we need to slow down on this cost management part. The company reported 3 very different costs for mining a single Bitcoin. Can you break down the $48,000, the $82,000, and the $55,000 figures?
Absolutely, because the distinctions are critical. The first number, 48,200, is the direct cost per BTC. That's power, direct site expenses, things like that.
And the second number?
That's 82,400. That's the total cash cost per BTC. It's much higher because it includes corporate overhead, financing costs, the full cost of doing business.
That seems like a really challenging cost structure, especially post-halving. But then they brought in their options trading.
Right. And this is so critical to their liquidity picture. They realized a $13.3 million gain from their Bitcoin option contracts. Think of it as their hedging program just paying off big time.
So when you net that gain against their total cash cost,
the cost is effectively reduced to just $55,200 per BTC.
So they were essentially subsidizing their mining costs by nearly $27,000 a coin using their trading program. That's very clever.
And with 1,658 Bitcoin in their treasury, valued at about $189 million, they had the balance sheet firepower to make this aggressive pivot.
Which brings us to the true centerpiece of the story, the massive capital raise in October 2025.
This wasn't just fundraising, this was funding a complete industrial transformation.
Taking on $588 million in unsecured debt is a monumental risk. Why take on that much leverage instead of just growing organically?
Because AI infrastructure is a hyper-expensive, high-growth field. If you move too slowly, you lose. They issued $588 million in convertible senior notes.
And the interest rate on those is key.
It's the whole insight, just 1.375%. For unsecured debt of this size, that incredibly low rate signals extreme confidence from the market in the AI pivot, not the legacy mining business.
Investors believe the payoff is guaranteed by future AI contracts.
I think so. Now, these are convertible notes, which means if the stock price goes high enough, the debt converts to equity.
Which could dilute shareholders. What are the terms?
The notes mature in 2031, and the initial conversion price is set at about $6.86 per share, a 30% premium. And to protect against massive dilution, they layered on this smart structure.
The capped call transactions. What does that actually mean for an ordinary shareholder?
Essentially, it's an insurance policy. Think of the 686 conversion price as the starting line. They entered into these capped call transactions with a cap price of $11.88 per share.
A 125% premium.
Right. It's like insurance against the stock becoming too successful too quickly. It protects the company from excessive dilution up to that 1188 level.
So they secured the $588 million, and they also completed their at-the-market equity program for another $375 million.
Yeah.
That's nearly $1 billion in new capital. Where's it going first?
The focus is strictly AI HPC. The first major commitment is a signed, fully funded, binding purchase agreement for $128.7 million.
And that's all for IT infrastructure and building materials for just one site.
Just one site. Their 18-megawatt Bitcoin site in Washington state, which is being converted for HPC AI workloads, targeted for as early as December 2026.
And this isn't just a simple refresh, is it?
Not at all. This is a state-of-the-art build. They're designing it to support extremely high power density, up to 190 kilowatts per rack, and advanced liquid cooling.
Which is validated for compatibility with the new NVIDIA GB300 chips.
And that GB300 compatibility and the 190 kW density, that's key for you, the listener. Modern, large-scale AI models demand this kind of extreme power and cooling. It means they're building for the absolute highest tier of client.
The ones willing to pay a premium for next-gen capability.
Exactly. And they aren't just converting old sites, they're locking in massive future capacity.
Right, at their Panther Creek location.
That's the second part of the plan. They secured an additional 350 megawatts of contracted growth capacity there through a deal with PPL Electric Utilities.
And that comes online in stages.
50 megawatts by the end of 2026 and another 300 megawatts by the end of 2027.
And the financing for that is also secured through their relationship with Macquarie.
Correct. They converted an existing credit facility into a project-specific one just for Panther Creek, drawing another $50 million for a total of $100 million drawn. That capital is earmarked strictly for hitting those AI development milestones.
This whole shift hinges on a complete overhaul of their energy footprint, now 100% North American. This brings us back to that Stronghold acquisition from March 2025. Why is owning your own power so important in the AI race?
Because reliable, low-cost power is the main constraint in the AI infrastructure business. Stronghold added 2 refuse power generation facilities with a combined capacity of 473 megawatts.
And these operate in the PJM merchant market. Can you define that for us quickly?
Of course. PJM is a huge regional grid operator. Operating in the merchant market means the company can choose. They can either sell their power to the open grid when prices are high, which is energy arbitrage,
Or use it for their own data centers.
or use it internally. This vertical integration gives them unprecedented control over their power costs and ensures reliability for those high-value AI clients who absolutely cannot tolerate downtime.
That kind of stability has to be a huge advantage when signing long-term tenancy contracts. So what does the total energy portfolio look like now?
Their North American energized capacity is at 341 megawatts. Their secured contracted growth capacity is 440 megawatts.
And the pipeline?
If you look at the total multi-year pipeline, they have secured rights for an astronomical 2,211 megawatts, over 2.1 gigawatts, and almost 90% of that is US-based.
That 2.1 gigawatt pipeline size, that alone tells you the ultimate ambition here. They want to be a top-tier player.
It absolutely forces that conclusion. And to cement the pivot, the company has explicitly stated it has no current plans to increase its Bitcoin hash rate beyond the current 14.8 exahashes. All capital, all focus is now on the HPC buildout.
This is a high-stakes, highly leveraged transition. Let's move into our final segment. This is not financial advice, but when we look at this story, we see a company that is betting everything. They're sacrificing years of cash flow and taking on $500 million in debt to fund this future.
A future defined by high-density, liquid-cooled infrastructure ready for chips like the NVIDIA GB300s. The execution risk is massive. They have to hit deadlines, secure tenants, and compete with giants.
But the potential payoff is a complete valuation re-rating. Right now, the market is still largely viewing this company through the volatile lens of a Bitcoin miner.
But the future cash flow will be modeled on the predictable, utility-like returns of an AI infrastructure provider.
Which leads to an outrageous but plausible trade idea. That convertible note offering provides a fascinating psychological benchmark. That $6.86 conversion price acts as a line in the sand.
If the company hits development milestones at the Washington site or announces a major AI client, the stock could re-rate very, very quickly.
So the trade idea.
Well, the trade here is a highly leveraged bet on that successful execution and the shift in market perception. You could consider buying call options with a strike price near that 686 threshold.
Betting that investors quickly shift their valuation model from BTC mining to AI revenue.
The goal would be to capture the move toward that $11.88 capped call price, where the debt issuance starts to protect against dilution. It is a bet that the speed of AI adoption outweighs the operational risks of carrying that new $500 million in debt.
So what's the core message we want to leave you with? This is a definitive, heavily financed pivot. The $588 million in debt, the $128 million Washington commitment, that is management's statement of intent.
They are all in on becoming an AI infrastructure player, strategically ditching volatile assets to fund this North American growth engine. And this leaves us with a provocative thought for you to consider. The company's total cash cost to mine a Bitcoin was $82,400. But after their options trading paid off, the net cash cost was down to $55,200.
So given that efficiency and their ability to hedge so effectively.
Right. Should their priority truly be to exit the Bitcoin market entirely? Or should they instead use that high-margin hedged mining fleet as a permanent, reliable internal funding engine to continuously fuel the far more expensive AI build-out?
It's the ultimate trade-off. Maximize long-term shareholder value versus ruthlessly eliminating perceived risk. That's definitely something worth chewing on as you watch their construction timelines.